This is the Books and Bitcoin podcast, and today I'm joined with Shaun Connell. Shaun is the EVP of Power at Lancium. And Shaun, before I even mess this up, can you tell us what exactly Lancium does?
Sure. So thank you for having me on the show, Dylan. Appreciate it.
Oh, it's a pleasure. I should have said that. It is a true honor and a pleasure.
Yeah. Well, happy to be here chatting with you. So what Lancium does is Lancium is an energy technology company. And what they do is they build electrical infrastructure and software that essentially allows you to convert large loads into power generators in reverse. And really what that means is that we're an energy transition company. So we believe that in the future, there's renewables are going to be replacing a lot of the fossil fuel generation. And to get from point A to point B, which is from fossil fuels, which is highly reliable generation, to a future state of a lot more intermittency, you need a bridge to get there. And that bridge is added flexibility. And since you're losing flexibility from these other, fossil fuel plants are leaving, you need to find new ways, right? So batteries are one way and loads are another way. So, Lancium is helping with this renewable transition by having these large flexible loads that can help with that transition.
Okay, so let me get this straight. Before Bitcoin, what would a typical grid like composition be?
So I guess it depends on when you start, right? So if you go back to when grids were first being formed, right? So grids were first being developed around 1900, right? So just the turn of the century. And at that time, there was no real grid. What it was just like people owning power generation assets and producing power for their own use. So for example, like an apartment building could have a power generator and it was just using for power for that building and, trolley systems, et cetera. And then this progressed over time where, the model doesn't work if you have to buy your own generator for just your own use. And you can tell that in how, people price out kind of solar batteries or other things in their house. It's just uneconomic. And that progressed until having these central power stations located far away from loads. And, essentially it was kind of building out these additional power plants that were, hydro was a big use case. Coal was kind of the starting point, but as grids progressed until call it like 2000, so about 20 years ago, the power grid consisted mostly of, nuclear, hydro, natural gas, coal. So things that you can be called on to be dispatched. And so there was no such thing as intermittent wind and solar, right? And so that's been really a story for the past 20 years, right? So when power systems were developed 20 years ago, the grid operator essentially kind of has the responsibility of, realizing what the load is on the grid, that they can tell by kind of what the frequency of the grid is. And if it's high, they make changes to generation, whatnot. But is that during this transition, the composition of having to actually, integrate renewables really made it much more of a challenge for these grid operators, where they didn't just kind of have generation on reserve that they can call at any time, but now they had these kind of intermittent wind resources that would just show up. So there's been a big shift that's happened over the 20 years from just going from, dependable, reliable generation that you can call at any time to dependable generation that it works, but just it's not always going to be kind of producing power when you want it. So that's been kind of the transition.
So one of the things I've picked up from listening to a few of your interviews is that, all right, so in Bitcoin, nuclear is a big thing. They're always talking about nuclear this, nuclear that. You can't have 100% nuclear because it cannot respond adequately. Is that a fair statement? Does that make sense?
Yeah, it does. And, there's a bunch of things about when we're finding solutions, you want to find the low cost solution, right? So you want to find the solution that works because people have to pay for it, right? And so, for example, if it required driving a Ferrari all the time to get groceries, like that just wouldn't work because the cost of the car is so expensive. But you can, have other cars that are, from point A to point B for serving what you need, right? And so, the challenge with nuclear, so you can kind of look at it as like existing nuclear, and then kind of, the which you hear a lot about, kind of also on Twitter for Bitcoin, Twitter about kind of like, hey, we should just build nuclear. So building new nuclear is very expensive, right? And so it's often kind of compared to that that it's a zero cost energy, right? And so zero cost energy doesn't mean zero cost. It means a huge capital expenditure at the front, and then a lot of maintenance costs along the way to kind of keep this plant up and running. So we often hear a default to kind of, well, the cost of the fuel costs this, and wouldn't you rather have free fuel? And of course you would. The example on that again of drawing a comparison is like if you bought a brand new Tesla, right, and it has zero cost for low cost for electricity. Well, you might be paying a couple $100,000 for the car up front compared to another car. So it really works out to be probably more expensive for that car in the long run because you have this big capex cost. So I guess as a starting point is saying, nuclear is a great solution. Like my opinion is that the future requires a whole bunch of solutions. It's not A or B. But what Bitcoin mining can do is with existing nuclear is that existing nuclear, it's nuclear power is not meant to be ramped up and down. It's meant to be at a static baseline. Every 18 months or so, they take these nuclear plants offline for refueling. They refuel the plant, and then they're up again for another 18 months. So they're not meant to be ramping up and down. However, there is, and you probably heard this kind of mentioned, maybe on the podcast I've mentioned some others, is that if you co-locate a flexible load right next door to that nuclear plant, the nuclear can still run base load around the clock. But since you have this load beside you that's consuming, essentially you're, upgrading this nuclear power plant into a flexible nuclear power plant, just because whenever the grid might need to kind of have a ramping up and down, instead of ramping the nuclear plant up and down, you can ramp this mining facility up and down, right? So that the mining load gave you the flexibility from that nuclear plant that can then be used as added flexibility for a grid.
Gotcha.
That kind of makes sense?
Yeah. So essentially, every energy provider could benefit from having a co-located Bitcoin mining for their demand response, but it's just even more useful with renewables because renewables like wind and solar are intermittent in themselves.
Yeah, so think about it as just kind of like in this future, which in the United States, there's different levels of renewable penetration at different locations. If you're up in the Northeast and you're in kind of the New York ISO and kind of up in New England, very low. It's call it 5 to 10%. Whereas you go into areas such as in ERCOT or California, last year the percent of energy that came from just renewables, which is like wind and solar, was greater than 25%, right? And so that causes this added requirement for days when it's very windy, is that you don't need to have a lot of this dispatchable generation, but during the day this can go up and down, and you need to be able to balance the load on the grid every second of the day. And so the real challenge is saying, like, as you're bringing on additional renewables and you're eventually getting to this transition, and I'll just make up the stretch case of saying, if grids are 80 to 100% renewables, right now we've just experienced 5 to 25% where we encounter this volatility. And so the problem is that you need to have more renewables, but you need to have flexibility, right? And so this is kind of a solution on how do you create flexibility given current infrastructure. So for that nuclear power plant that was not rampable, well, you can make it flexible by having a load co-located that will be able to give up those megawatts whenever the grid is needing it, right? So it's a bit of you're upgrading that nuclear power plant through the the type of load that you have beside you that you can dispatch up and down. You wouldn't want to co-locate with everything. So just your question was like, should every power generator have some type of load that's flexible beside it? And so in this future, as we're making this energy transition, is that you want to be careful about having these loads that are kind of being located with fossil fuel plants that might be just extending the life of the plant and actually not providing value to the grid, right? So it's saying like, there's a scenario where you can say, put one of these loads next to a natural gas plant on the grid, right? And what that's going to do is it's going to be a flexible load that can dispatch up and down and provide kind of, energy balancing or providing some of these, we'll get into these called ancillary services, which is kind of insurance, if you will. But if you put it right beside, like if you put it co-located with a coal plant or natural gas, those coal plants or natural gas plants, might be coming offline during the morning hours when there's less demand. And now that you're putting this load beside the power plant, they're running base loaded, right? So you're essentially, creating kind of more incentive for those plants. They're running around the clock and that they wouldn't otherwise be running, which is kind of additive to this kind of, it takes away from the transition a bit, right? So, it really pairs well with plants that are like a base load plant, such as nuclear, that gives you that flexibility is kind of is a great use case.
Okay. I get it. Okay. A few things I wanted to go through. So to help maintain the heartbeat of the grid, and the heartbeat of the grid is 60 hertz, roughly.
That's right. Yep. That's right.
Okay. What is a watt? What is a volt? What is a hertz? Or what is a hertz? And what is an amp?
Yeah, you're asking the wrong person for the technical expertise of the engineering of the grid. I would say that I've heard some other folks on podcasts. There's a gentleman named Blake King. He is electrical engineer and can have precision answers for those types of comments. Where I say is that a strength that I have based on kind of past experiences is understanding the different market designs across different kind of jurisdictions, as well as just kind of how these all mesh together for the fundamentals of power grids. But I'm definitely not the technical electrical engineer. But what I do know is that the grid needs to maintain the 60 hertz, and if it drops below a certain threshold, so like in the United States, that 60 hertz is a threshold, and if it drops below, I believe the number is 59.3 hertz. Right, then all of a sudden, load that's connected to the grid, needs to protect itself because it senses that something's wrong and it needs to have this, this power that's delivered at certain hertz. It'll start to disconnect from the grid. So the analogy is it'll go into a heart attack, right? So once you get to this level, things will start to kind of cascade and turn offline. So you really need to make sure that frequency of the grid is set, because the equipment that is connected to the grid needs to be operated at that power frequency.
And then if you go over, like let's call it 60.7, is it the same consequence or is it a different consequence from going below and going over?
No, it's a great question. It's the same thing, right? Because what that means is that you've got too much generation on the grid, right? And you need something to either turn offline for that generation, or you need something to soak it up. And so this is an example where you could be middle of the day and there's kind of like some clouds that are covering like a solar farm, and the clouds move away, and all of a sudden there's this surge of power that comes to the grid because the solar farm now is actually producing power, right? So you either A, need to get that solar offline or something else, or B, find some home for that. And an example for that would be a battery is a great case, right? Because a battery can absorb that for that period of time and then inject at a later time. Another use case, and as we're getting into different break-even points for Bitcoin, they can serve different use cases, right? And back in October of last year, the break-even price for an S19 miner was about $500 a megawatt. That break-even price is now 120, right? And so like under a really high break-even point, that miner always wants to be consuming. And by the way, this is a 500 for an S19 and roughly like 150 for an S9. So essentially the same metrics for the S19, but divide by 3 for the S9. So now we're into this point coming into summer, and the break-even price for these miners is 120, and the S9 is 40, right? So that's a really new use case for power grids, because instead of this Bitcoin miner, kind of running the majority of hours and, coming down when there's price surges above a certain price, or this miner is also being able to provide these insurance products and being the low cost provider, because for mining to produce that insurance is they just need to be running and to make sure they're running. And so they actually can beat out other generations for providing that low cost. But as we go into these new use case where, Bitcoin mining becomes commoditized and, there's more competition happening and their break-even points are dropping, right? There are scenarios where what you said is saying is like, what happens when the frequency is too high? right? And so now think about a Bitcoin mining load, and we'll use easy math, is that it's a 100 megawatt load, right?
Mm-hmm.
And so then during this 100 megawatt load is that, you can run this miner at 50 megawatts, right? And so now a grid operator can use this for, there's an ancillary service product called reg up and reg down, which means it manages the gyrations that kind of happen from every 5 minutes. And so they might need to have, they're under, they need 5 megawatts, they need to give 5 megawatts. So it's kind of like the balancing up and down. And so these miners can run so that they can actually kind of, load balance and provide the service. And an example where there's a frequency that's too high, right? They can take on more load, right? Similar to a battery, but I also want to be very pragmatic in the response and saying that, batteries do a fabulous job of this absorbing of power. So they are part of the solution. So it's not just a future of Bitcoin mining loads of providing flexibility. It's back to that and statement, right? It's you want to have a whole bunch of different tools that can do this, that allows you to onboard more renewables as these fossil fuel plants start to retire.
Okay, so if I'm not mistaken, Lancium has a 100 megawatt facility in Abilene, a renewable facility. Is it like a wind farm?
Yeah. So what Lancium has right now is that we're in the process of bringing on a facility in Fort Stockton, which is a smaller facility. It's about 25 megawatts. And then we have another one that's coming on in Abilene that's scheduled for 200 megawatts, and then another one for Fort Stockton. So these are in the early stages of coming online. Well, one's coming online and these other ones that are in development.
Okay, I was just curious. Like, I didn't know if this was theoretical or if this was being done now, seeing the benefits now, or if this was proposed and, about to happen.
Yeah, so Lancium has technology that, let me kind of go back to the start where, like, I believe it was in 2003 in ERCOT, they started talking about this controllable load, right? And a controllable load was kind of like the holy grail, because a generator, a system operator has control of the generation, but they don't have control of the load. They just have to kind of forecast the load and make sure there's enough generation online. So there's talk, 20 years ago about having this, controllable load. About 10 years later, in 2000, I think it was 13, they came out with this rule revision in ERCOT that essentially created this new type of resource, which is this controllable load resource. And part of the requirements for this load resource, controllable load resource, is it needs to be able to do base point following, which means that similar to a power generator that receives instructions from a grid operator for being dispatching up and dispatching down, as they receive this base point, and they need to be able to follow that. The second thing they need to do is when there's something that happens on a grid where there's a plant that trips offline, right? It can have a big impact on the frequency of the grid, and especially in Texas. And the reason is that Texas is an island. It's an electrical island, not connected to the other grids. And so ERCOT has a special need for what's called primary frequency response. And what this means is that within a short period of time, typically this has been provided by generation, that the generation can inject additional power into the grid to compensate for this plant trip offline, right? And so this is happens in seconds. It happens automatically. It's not like somebody making a decision, or a phone call and saying we need more power. It needs to automatically detect that there's been a change in the frequency of the grid, and you need to inject more into the grid. So part of the requirement on this controllable load was that you base point follow, and you need to be able to do the same as generation in providing this primary frequency response, which is very hard to do. And so this rule came out in 2013, and it was talked about, and kind of, I believe from what I've heard, there were several companies that tried to kind of implement this at their kind of industrial sites, and none of them could do it, right? It just wasn't possible. And then Lancium in 2020, with the IP we have, we're the first ones to actually qualify as a controllable load and meet that threshold.
Okay.
So for Lancium is that we, in this energy transition, is that, we can decide to, just use it for ourselves, or we can, really kind of help and kind of providing more flexibility by also having licensing to others. So in ERCOT, it's in commercial application, and it has been for 2 years. Okay. There's a website that I can share a link with you after the show, and readers can look up, but it'll show you exactly in ERCOT, how many megawatts are being provided by controllable load resources for this ancillary service product that's called RRS, which is essentially the responsive reserve service for managing that frequency and kind of a backup power. So to bring back to what you said, is it's been commercial application for almost 2 years. And so now we're actually starting to develop it for some of the campuses that we're going to be using as well.
So for ERCOT, when ERCOT signals to Lancium, like here's the price signal, they're essentially wanting you to buy energy when they want you to buy, like when it's cheap, there's high demand, and they want you to take it in and mine. And then sometimes they need, or I guess when demand is low, they want y'all to buy mine. But then on the inverse, when there's high demand, do they essentially signal the price to ask y'all to sell energy back to them?
So the best way to think about this would be that generators provide these services, right? So think about a starting point as a generator, and a generator provides two basic services, right? So these are the two main things that the generations need for. The first one is they provide capacity, so a portion of their nameplate capacity of their facility. They can provide ancillary services, and I'm going to explain that in a minute. And then the second thing they can do is they can use the capacity for energy, and that is actually producing megawatts. So going back saying, what is capacity, and why do you need to procure that? And so when so capacity is essentially the insurance products needed by a power grid operator just to manage a grid reliably during the daytime, right? And so you think about it, it's like, during a day, you're going to have these kind of gyrations of kind of power being kind of overproduced, underproduced, and so you need something the operator needs something to kind of be able to manage that. There's going to be times when there's a plant tripping offline that was unexpected, and if you had nothing in reserve, again back to that kind of 59.3 and losing load, you could have this this blackout that occurs. So you want to avoid that, right? So you need to have some type of capacity on standby, which is the ability to produce power when needed to backfill this. And then the last one is just essentially these additional reserves of backup power, so that should anything happen, that you can call on these reserves, and they've got maybe it's called a non-spin product, and it means they've got 10 minutes to come online to meet that need, right? And so now starting with the generation, because it's important that I don't think it's really well understood in kind of, how does Bitcoin mining interact with the grid? And it's not some special kind of, it's not a special kind of methodology being used by grid operators just for these loads. They're just following the same protocols as generation, right? And so they're doing the same thing as generation, but in reverse. So you think about like a power generator, and, say I'm a 100 megawatt gas plant, right? And so I can do one of two things, right? And I can either sell insurance, or I can use my capacity for power, right? And so in the call of the market, there's a lot of nomenclature in power markets, but essentially this ancillary services are procured the day before the operating day, right? So they want to buy it in advance so that they're prepared for the next day. And so this power generator will say, okay, well, I want to sell my energy or my ancillaries. They're going to submit their offers into, we're using ERCOT here. They're going to submit their offers saying, hey, I would sell, here's my cost of generation. Here's all the kind of my startup costs, et cetera. And I'd like to participate in energy ancillaries, and ERCOT's going to co-optimize and give them the best outcome, right? That's going to be the best economic return given their cost of producing. So in this example, pretend that this generator was designated to say, tomorrow you're going to provide 20 megawatts of this responsive reserve, so RRS, and you can use the rest of the 80 megawatts for energy, right? And so now you go to the next day, and that power plant that sold 20 megawatts of 100, it needs to sit at 80 megawatts for the entire day, right? Meaning that at all times it needs to have 20 megawatts available to dispatch up, right? To meet that demand, because it sold this insurance, right? And so it must be ready to stand by to provide that. Even if prices go to, call it $2,000 a megawatt, like in power for the past 5 years, the average price of power has been about $30 to $50. It's now, call it 60 to 100. It's gone up quite a bit. But in real time, if this generator has an award, right, and real time prices are high, right, it can't dispatch up unless ERCOT calls on those megawatts, right?
Okay.
I think I link this back to Bitcoin as well, because there's been some kind of questions about why would a Bitcoin miner not be price responsive when prices are high, right? And it's good to kind of start with the power generation side. So this generator has got 100 megawatts, sold 20 megawatts the day ahead, and if they didn't sell any energy, but they just sold this ancillary, then they've got 80 megawatts in the real time that they can essentially be dispatched to what the price is, right? Mm-hmm. And so they'll receive some a signal that says the price is here, this is your marginal cost, so the plant will ramp up because it costs less to make power than they would get paid for producing power. But the key takeaway on this is that a power plant can do one of two things: sell capacity, or or sell energy into the market, right? Mm-hmm. So now go to the Bitcoin miner. Is that for the past 6 to 12 months, these break evens have been very high, right, for the price of mining. And so the way to think about this, if you're a controllable load in ERCOT, what that means is that you are able to sell any ancillary service the same way that like a generator can, same rules, right? All the rules that apply to the generation, that you're open to participate in these markets. So if you're a controllable load and that you've sold the ancillary service for the next day, there's a clearing price, right? So think about a grid operator as like as a clearing house that sets prices, takes in all the kind of bids in the stack, and then says the marginal megawatt, this is the price kind of where the supply and demand stack up. Mm-hmm. So there's a clearing price for this ancillary service. And so let's use the example of saying next day in ERCOT, the price is expected to be $100, which is an expensive day. And you expect that the clearing price for this ancillary service will be $30, right? So as a controllable load is that you can sell this insurance product for $30, right? And now assuming you're a 100 megawatt facility and you sell 100 megawatts, right? That means the next day you need to be consuming 100 megawatts around the clock, because they need to be able to call on that whenever, the same way that generator could be called dispatch up, you need to be operating at this 100 megawatts the entire day, so mm-hmm. that when they do call on you, you can turn down. Okay. And so the economics of the miner are that they're going to buy the price of energy. So assuming that they're just buying the real-time price, and assume that the price actually cleared $100, you're buying $100 power, you're simultaneously selling this $30 ancillary, and that your net payment for just the energy is $70 per megawatt. Now, if your break even, right, for the past several months has been north of $200, $300, you're going to do this consistently, right? Because that is a great service that you can provide, where you can provide this ancillary service. And since you're competing against other generation, if you're being awarded that award, that means that you are the lower cost provider of that service, which essentially is lowering prices that are paid by ERCOT customers for having to pay for these insurance products. So the takeaway on this is that generators provide energy or capacity. And the same thing can be said about a miner, is the miner can actually sell its capacity for this ancillary. If it's sold its capacity, that means in real time, it must stay at that load level. So it must consume energy for that time. It'll get paid that amount of award. So even if the price in the hour went to $800, they're not allowed to go off of this, the ledge that they're at for that power, that they're 100 megawatts, because they'll be non-compliant and subject to penalties. And so when miners are participating in these ancillary services, is that these are not voluntary participation, right? Like, you're paid for a service directly from the grid operator, and if you don't do it, like there's consequences, financial consequences to doing so. And so it'd be very expensive to just decide to do something different, and it would not be a good outcome. So that's why you're following instructions as per the grid operator instructions. Okay. Is that helpful?
Very, very. So I kind of wanted to touch on, I just moved that super far away. Before you got into working at Lancium, you were in the energy markets for 15 years. You were, I guess, were you trading like paper energy?
Yeah. So I started in 2002, right? And so the way to think about power markets is that there's a physical market and a financial market, right? So the physical market is just literally like, where are the electrons flowing, right? And there's going to be like a real-time price based on a physical market, right? So like a power plant produces, physical megawatts, they get injected to the grid, and there's a price for those megawatts at that point in time that you're going to get paid. So this is like the actual real-time physical market. The financial market is just essentially the ability to transact and to be able to kind of forecast. If you're forecasting where prices are going to be, you could do some financial transactions that kind of can have a link to the physical market that can provide you with hedges. So my background was that I started at a power generation company here in Alberta in 2002, and it was when power markets were just being deregulated. And what that meant was prior to 2000, there was a ratepayer, right? And the ratepayer was the customer. So you'd get a power bill in the mail, and you had no say in kind of what the power costs were. Then the power costs were determined by utility commission for the province or state, and they would say there's going to be some guaranteed rate of return that this power generation company would have. The power generation company would own the generation, they'd own the wires, and they'd also do the billing to the customer. So it was a full vertically integrated monopoly, right? Mm-hmm. And then post 2000, so this is the end of regulated monopolies, and some terminate at this point, and the start of some markets being deregulated. And so what that means is that you now own a portfolio of generation that is not contracted anymore, right? And so now you need to find a home for those, right? So like there's going to be an eventual physical settlement for that power, right? But you need to find different ways to be able to lock off the margins from your producing the power, right? And so this is similar to what I'm doing with Lancium right now, is that how do you essentially lock off the margins and de-risk a business so you're not exposed to these big swings that can happen. Mm-hmm. So the example in this power generation side is that so there's a couple of different ways that you can lock in what your production revenues will be from this generation. One of them is that you can sign long-term contracts with customers, right? So go on to like a Bitcoin miner, so a large industrial customer, a steel plant, a cement plant, et cetera. And you can tell that cement plant saying, I will sell you 100 megawatts for $75 per megawatt, right? And so now you're locking in the price for the power, and that's a financial contract, right? Because you're essentially guaranteeing that they're going to pay you $75 regardless of what the physical settlement price was, right? Yeah. So this is where you need to layer over top, like the financials and the physical, is because you can't change the outcome of the physical, but you can enter into these contracts for locking off the financial side. So when that customer is paying you $75 per megawatt, and if the price was actually, the physical market was $45, well, the producer of that power was the one that benefited, that it was $30 over the actual the physical price. Whereas if it was actually higher, then the customer would have benefited in saying, hey, I would have had to pay much higher, but I got to lock in this fixed price. And the point on the example here is that they both win in this contracted price, because the customer that's buying those $75 power is going to be doing something with that and making economic decisions around that. Mm-hmm. So they are both benefiting from this example. And so there's various other ways of doing different financial transactions, but the punchline is that you're using these financial transactions to kind of hedge out these exposures, to lock in what those revenues are. And so it's a combination of the financial paper and the physical market that kind of net those two out.
Can Bitcoin be used as a hedge as well? Like, you could sell the contract for $75, and then you need to hedge that in case it goes to 120. So I guess you have to buy, like, let's just call it like a long call on oil, whatever, I don't know. But on top of that, would you be able to add a layer of Bitcoin, shorts, longs, spot, to add increased stability? Or would that not even help at all?
There's lots of different models, right? So there's not a one size fits all. Like even in power generation, there's a model where in power generation companies. Most of them are public companies. And if investors in that company, the majority of the investors in that company, like want to have exposure to energy prices and gas prices, right? They're going to try and buy the stocks of power generation companies that are not hedged, right? Because they want them to have that upside exposure. And you can think of it the same way as like it's Bitcoin, right? It's like if you want to have Bitcoin exposure, right, you're going to buy a miner that's not going to hedge their Bitcoin prices, right? Because you want to have that Bitcoin upside. Whereas the majority, well, I think the majority of investors in power generation companies are looking for kind of, the stable returns of these businesses, and they want to make sure that they're, hedging out their risks so that, it's a, consistent earnings and cash flows in these businesses. So the point of that was that there's many different models in power generation, and there's going to be many models that come out of Bitcoin mining. Pairing the miner with the power generator is that, there's a model where a power generator owns the mining facility next door, right? And then there's a model where that power generator is selling to a miner next door, right? So those are two different ones. And so I'd start with is that up until now, like there's been very limited options for power generators to have an off-taker of power that could match their maximum amount of power that they can produce, and to give them an option to sell to somebody else. Examples in power generation companies is that they will often locate in industrial areas of a town or a city, and they'll be located next to industrial customers that can take part of their generation so that they can enter into these contracts with these industrial customers and then provide the rest of the power to the grid, right? And so they do have an option, right? They've got a customer, but that customer can only take so much power, right? Just to the size of the steel plant might be a 10 megawatt steel plant, a cement plant might be 15, and a 100 megawatt power generation plant, that steel and cement plant can't take all the power. So the rest is going to go to the power grid at the spot price or at some agreed to price that you had a financial contract. So the punchline on your question is saying, like, is there value to kind of mining and additional cash flows, and kind of, how would you think about this? Is like having more than one customer is way better than just having one, right? And so like in the model where you have in the simple model of just, selling to a miner, right? That's giving you kind of an added customer that's similar to the industrial customers of the past, except that miner can scale their business as big as you need it, right? Where that steel plant or that cement plant, they can only scale to the size of their business, right? It might be locally constrained, but they can't scale it, right? Whereas a Bitcoin miner, under the right conditions, they can scale it to whatever they want. And so this is a great kind of off-take example where a power plant has, some industrial customers. It can add Bitcoin miner as a customer to the list, and it gives them additional flexibility. And how do they monetize their generation production going forward? Now, on the more complex model, which I think is something that's going to happen, is that power generators can actually own the Bitcoin miners. And if you think about, for the past 20 years or so, these power generation companies have matured in being to really understand how to manage their generation assets and to really monetize them. And they view their assets as like they own a basket of real options, right? These power plants are just options. And how do you extract the most amount of value from these assets? So if you take a power generation company that says, I'm a 100 megawatt power plant, and I'm going to put a 100 megawatt mining facility beside me, and I'm going to own it and I'm going to operate it, right? They can, since they developed the competencies over the past 20 years on trading in these markets, they likely have already the infrastructure in place on, it's just another one of those things, right? It's just an additional commodity, right? And so now they can actually look at the Bitcoin mining, and this is something that is not being done, to my knowledge, in the mining space. And it's part of that kind of the Bitcoin exposure and hedging side, is that, a power generation company that has the culture and kind of like the expectation of managing kind of cash flows and margins can look at this mining facility in the same way they look at a, 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 generation production forecast, which is kind of what do I expect to produce megawatts in the future, they look at this mining facility and say, well, what does this mining facility expect to produce for hashes in the future, right? It's just a forecast. And then there's various ways that the power generation company can optimize that facility in combination with, connecting with the grid power. And so for Bitcoin mining is that you can actually hedge your mining facility by essentially looking at kind of the hash rate forward and saying, I'm going to make some assumptions on the growth of hash rate, right? And they're going to be more accurate in the first few months than they are in the next year, right? But I've got, pretty strong certainty about next week, certainty about the next month, but, as you go out, you get less certain. So you can convert that into saying, what do I expect to make for hash rate? And then what is the conversion of that hash rate to Bitcoin going forward? And then you can actually hedge the Bitcoin, right? Because you're expecting to produce Bitcoin from this facility and you're making assumptions on the hash rate. And so this power generation company with a trade floor and these competencies can just look at this facility the same way they look at it as a power generator, and they'd be able to do an excellent job, in my opinion, of extracting great value out of these facilities, and be able to hedge them at times when the break evens are really high, when they're kind of deep out of the money option, to essentially kind of when power prices are at the same as the power price. So when the Bitcoin break even is the same as power price, and they're now long and at the money option. So there's a lot of value in that. So that was a mouthful, and that's quite kind of deep in the weeds. So I wouldn't be offended if you told me that you only caught a small portion of that.
No, I got a good bit. I'm definitely going to go back and re-listen to this. So I had another question. It made me, when you were talking about commodities, it made me think about it. So I have a very basic understanding of like markets, but what I have gathered in life is that commodities are typically cyclical, where they have a period of overinvestment and then a period of underinvestment, and this kind of happens. And all, does this happen in renewables as well?
Well, yes and no. And I would say that, so renewables have been around for 20 years, right? And so I would say that the commodity that renewables are producing is electricity, right? And so like, essentially it's kind of like, what is the cycle of, electricity overbuild, underbuild? And so the commodity is electricity, the same way like in oil markets, right? The commodity is oil, and, there might be certain locations that might overbuild and, some underbuilt, but really the commodity is oil. Where you will see the overbuilding of renewables show up, and it's not so fast of a cycle, because where in a commodity cycle where you overproduce, you have to kind of stop producing, and then demand picks up, and then you over under, back around. When you overproduce with renewables in a certain area, what shows up is negative price energy or low cost energy, right? And the challenge with that is that you can bring on, call it like 10 gigawatts of wind in, a handful of years, call it 5 years. But you're not going to bring on 10 gigawatts of demand in 5 years, right? You might bring on like, you don't get to decide that, right? That's going to be driven by kind of like the economy and kind of the growth of that area. And I mentioned this before on a different podcast, but in commodities, kind of think about how commodities can be shipped around the world and the ease of moving commodity around. And so you think about like coal, right? Coal is the easiest, right? Because you can just, put it on trucks, you can put it on a boat, or you can put it on rail, anything, right? It's just, can move it around. The next commodity that's the next difficult is oil, right? So oil requires that you have some pipelines to get to the refinery, and, some ability to maybe to get to the ships, but, it's pretty easy to move around. You can get them in barrels and you can put them on however you want, but, there are some limitations, but overall pretty good for saying that you can't have oil prices in Europe of $200. So call it, the location is Brent. You can't have Brent oil for $200 and oil in the United States for 100, because people take the $100 oil, move it to Brent, and it might cost you, I make up the numbers here, but $10 of transportation or $15 of transportation per barrel. So that spread will, collapse, right? So then go from coal to oil. And the next one is natural gas. So natural gas requires pipelines that are located within the geographical area. that are connected to processing plants, and then they get passed on to power plants or other end users. To be able to move natural gas from one continent to another is that you need to be have LNG capabilities, and so having the ability to convert to LNG and then convert back to gas at the other location. So it requires a lot of infrastructure, and we're seeing this right now in Europe. Natural gas prices here in North America are $6, and natural gas prices in Europe are 30, right? So there's a big break, right? And so like in a market such as oil, that would just collapse together over time because you'd move all this oil to Europe. But the problem is that we can't move the natural gas to Europe because we don't have the infrastructure to do that. So the complexity gets a little higher. So we've gone coal, oil, now natural gas. And then the last one, which is the most difficult, which is electricity, right? And electricity is essentially generation connected to wires. And so think about a spider web that connects all these different generation facilities. And you can have these pockets, such as in West Texas, where there's a lot of renewables located in that area. And think about this as like, the same way that there's natural gas deposits and oil deposits and coal deposits, there's these areas with really large renewables deposits. And what that means is really great wind speeds, really great sun quality, that you can produce high amounts of renewables based on the same kind of capital expenditure. You get more in these areas versus in other areas just because of the quality of the wind and the sun. And then you can produce these renewables in these areas, but if there's no wires that can take that energy from that location to another, it's just wasted, right? Like you've generated it in terms of, you say, like you've spilled it.
Okay. And so that kind of answers my question, because there really can't be a cycle to it, because it's so specific where you're actually going to put it. And then the demand is, you have to forecast it, but so essentially you're going to build to the demand, and then you'll build to the demand, right?
For now. Yeah.
Okay.
Right. And so in that cycles thing you shared about is that, you can have these renewables that are kind of overbuilt to an area. They got to wait for transmission lines to be built, right, to get that to come away. And if there's none that are built, or no load that can come to that area, right, they're trapped because, there's no price signal that's saying, do more of that, right? And just the last point on this, Dylan, is that, so how do you move electricity from, West Texas to Europe, right? And so the options are, well, to be fair, you can't, right?
Yeah.
Right.
Yeah.
But the way you can do is you can put a battery, right, in the panhandle, and it can be like a 10 megawatt battery for 4-hour duration, and you charge it, and you got 40 megawatt hours, right? And then these things aren't movable, and then pretend they were. They can move this really big battery, put it on a boat, and bring that power to somewhere else, right? But that's super expensive. It doesn't make sense. In the future is that, what we're kind of seeing progress is the idea of using electricity to convert into some other type of fuel that can be used, that has flexibility. So the example is, and this is still early and it's a buzzword, is in hydrogen, right? And so like if you can use electricity from these areas that are really rich with renewables, and the economics pencil out, you can convert electricity into hydrogen, and then the infrastructure needed then can move that hydrogen to some other location across the world, right? We're a ways away from that, but just it's foreshadowing, how do you relieve this congestion? It's either transmission lines, it's new load located, which could be, Bitcoin mining that needs to be controllable or flexible, as well as these hydrogen facilities that can be kind of built out as well. So it's bringing the load to the source.
Okay, that's like very interesting. So there was some you said when you were just talking, and I'll quote it wrong, but you were talking about like the Brent and West Texas Intermediate, I guess, right? Is that what it's called?
Yeah.
And how the prices converge. And I've heard you mention this before. Prices always converge. When you told the story of how you got into Bitcoin, I think it was like 10 grand, but then you asked how much it cost to mine, and it was 2. And you were like, I know what's going to happen here because prices always converge. Can you expand on that? Because I've heard you talk about, okay, if Bitcoin rallied to 100,000 overnight, and like what would happen? That blows my mind, and I still don't fully understand the concept of it.
Yeah, so think about it as, for hash rate to be added to the network, right? it needs to be economic, right? It needs to pencil out that you've got this CapEx spend that you've put a cash outlay, and you need to be able to locate in some area that you're going to get your capital back in some type of return, right? And so then, so think about just like very basic of just, like, and it's the same thing for power generation, right? Is that, as power generation is going to go to some area, there's some hurdle rate that they have that need to have a rate of return. So call it like 10%. And if they go to some area, they say, okay, well, the power price is good here. We can get this offtake agreement. We can sign this, contract for building this plant, 10.5%. Good. Let's lock it in. Let's start building this project, right? So does it make sense that there's this massive competition around the world for having projects that have some type of rate of return, and 10% is excellent. Whereas there's Bitcoin mining that at times can have this rate of return of 1,000, right? Like I'm making it up and I'm a stretch exaggeration, right? But, there are times when, you can have it so that the capital outlay for your mining and your operating costs, I use the example of a break-even cost of $500 a megawatt, is that now assume that your power cost was $50, and we can talk a little more. I wouldn't mind chatting about, like, because your power cost is not your only cost in your bill. It's just a portion of the cost, but it's the one that's referenced the most. But assuming like your capital cost is that you need to recover $50 every hour for 4 hours to recover your CapEx, right? And then your operating cost, which is your power costs, and assuming again it's the only cost, is 50, then you got $100 per megawatt as your CapEx recovery and your OpEx cost. If you're making $500 an hour, like that's just crazy, right? It's just a $400 spread. So it's going to attract attention, right? Anybody in the right mind that's, fighting for these 10% projects is going to say, well, why am I not fighting for that project, right? Because that thing is just crazy, right? And so the signal, and we talk about this, I talk about this often in power generation, is like the market signal is super important, right? Because it's going to incent behaviors, right? So negative priced energy in a certain location for lots of hours in the year, you're going to have Bitcoiners setting up facilities in West Texas to go capture that because the signal was right. Right? Imagine that signal was muted and it was, covered up with something, it wouldn't get the right behavior, right? And so the signal being sent on Bitcoin mining is saying like, hey, this is super profitable to do so. And so you're going to attract the attention of all these other folks that are going to try and chase the same returns. So you got to think about, like, in Bitcoin mining is, when would you not add a facility to the network? Like when, where's your hurdle rate that you say, I can't do it, right? And it can't be perpetual forever that these projects are always in the money to do so. That's insane, right? Like, and so we can go back in history, and I can't think of specific examples, but like there would have been some niche areas as they're developing where these returns are just astronomical, right? And then competition comes out, the industry matures, and because Bitcoin is truly a global commodity, right? And so if we want to have the luxury of saying that like Bitcoin is global money and global energy, we have to realize that there's, what's attached to that is saying that it's an unconstrained global energy, meaning that, where you're located today and where I am right now is that there's no congestion, meaning there's no kind of prevention of, me getting access to the network versus you, right? Whereas you can go to some power grids and there is congestion, meaning that, there's no wires available and you can't connect that power to certain locations. So with global energy, right, that global energy should eventually in the long run be priced less than local energy, right? Because local energy should be the premium, right? Because it's a lot more kind of challenging to get these wires and this distribution and all these things, right? So this global energy should be lower. So what I share on kind of like, the convergence of price is that, when the break evens are super high, right? Well, then you're going to get this massive surgence of folks that are coming to the network. And kind of to your point of the commodity cycles, right? This is exactly the same type of thing, where you overproduce, you underproduce. And it's hard to not, get caught up when, things are good to say this time's different, right? Because it's just natural tendency to do that. Yeah. Right. But, the time to kind of add mining facilities to the network would have been, at the start of 2020 when there's extreme pain, right? Like an S9 miner back in 2020 was making $45 a megawatt hour. By summer it was 30, right? People were giving away their miners. Like they're saying, just pick them up and, you pay for the transportation, you can take it because they weren't economic. like that's the time when you're saying you should be building. And, we're coming up to that right now as well. Right.
Mm-hmm.
And what happened is there's this massive move in price, and people are looking at this saying, holy geez, look at that spread on this. Like we need to get these facilities online, right? Because we need to chase that price, right? And there was a chance that price never came down. And in fairness is that, Bitcoin in the short run can be irrational on this price, spread for a very long time, right? And have all this kind of hash rate kind of chase the network. But what's happened over the past, 10 years is it's had these cycles of these kind of corrections that happen. And during those times is the inefficient machines that are connected to the network get priced out, right? And so, bringing it home, I guess, is like, so for these prices to converge, like we're near there right now because you're starting to see the economics of these miners being close to the same price of power. In 2020, in like the June of 2020, as power prices were like $30 and the S9 was $30, right? They were the same, right? And so like, it was like, oh man, nobody's building anything. There's no hash rate coming to the network. People are getting rid of the machines. And then you get this big move up and everybody's chasing, right? But there's, so there's this chase that happens. And at some point you need to have it where it's not in the money for some of these miners, right? The party can't go on forever. And, the last thing I'll say on this is like, the same way you're not mining on your laptop because it would probably cost you, say, $5 of energy for 50 cents of Bitcoin, right? And I'm sure there's some Bitcoiners out there who say they'll do that, right?
Yeah, but not in the pool. They're just trying to win a lottery,
right? So like the laptop was priced out, right? Because the Bitcoin mining network grew and it was inefficient. It didn't have the the efficiency of the hash rate. And so like in this cycle, you can look at this and say, well, currently the S9 is making about $40 a megawatt hour. And if you're connected to the grid, you're now priced out because the price of power is, in summer is like 100, north of 100, right? And so like there's this natural cycling where the S9 should eventually get priced out and be not efficient to the network where you just can't run it unless maybe you're pairing it with renewables at some place that, again, the free energy, but it's like you're using older miners to make the economics work because you don't need 100% uptime. But it can't be in the money forever. And so these cycles are just natural. And so it's just observing when these kind of, cycles occur and you see these kind of, really big margins. And I saw them and I didn't change my behavior. I also said, maybe this is, this time's different, right? Because it's really hard in that moment to say that, but the hindsight ticker tape is usually very telling.
Yeah. Okay. Yeah. So not only is the price of Bitcoin going to converge, or like it's probably converged right now, very close to it. But when we see these miner prices coming like S19 XP, whatever, coming out, like they're like 20 grand, and then they come down to 8,000, we can expect that. Like you would expect that going into the future pretty much for the life of Bitcoin, forever. Rally, drop, rally, drop.
Yeah. So I guess kind of think about like, yeah, I do. And it's, the best way to think about like a miner that's connected to, that's plugged in and hashing is a printing press, right? And so it's going to be printing out something of some value, right? And if that value is, in this example here, say that value is $500 per megawatt hour, right? Then you think of that value chain again of kind of like the manufacturing and, the infrastructure of the actual owning the site to connect the miner, and then the operations of the miner is that if somebody's owning a Bitcoin miner and, prices are sky high, is they can command a pretty penny for having a mining facility up and running. And because you're just handing over a cash flow, right? If there's limited capacity for kind of plugging in those miners, well, then that space gets bid up and, those rates go up to connect the miners because you understand how much value can be, accreted to the person with the miner. So it's kind of, there's a couple of things is that, that the market is kind of at its point where like it's at the bottom of the cycle when a mining manufacturer, an ASIC manufacturer starts selling their hardware for lower than their cost, right? Because that means that they're like, man, we got too much, right? And we just need to create these cash flows to pay some things, but like that means that they're tapped, right? And then the miner on the other end is just maybe covering enough or not for their cash flows. Like, oh man, like we're tapped, right? And so when those pieces are lined up, that's really the bottom of the cycle, right? And making the assumption, of course, that, Bitcoin's not dead, which has never died before, but, throwing it out there that under the assumption that Bitcoin's not dead and there's a recovery, like that is a really good tell of the bottom, right?
Okay.
And
is that also the best time to start mining? Because now people are in so much pain. I'm assuming, like I haven't looked at the hash, I'm assuming the total hash of the network has dropped. So now you can probably mine more Bitcoin. I mean, it's a lower price, but you could accumulate more in this period of pain for everybody else. And then so long as you hold that 4 years, if you're expecting a cycle, then you just made out like a bandit.
So I think these are good times for Bitcoiners that have friends that aren't Bitcoiners to introduce them to Bitcoin, right? And it's we all introduce folks to Bitcoin when prices are high because you want to share about Bitcoin, right? But just like, out of love for your friends and family, like this is a really good time because, you might be in pain of saying, I've been holding on to this and I'm just like, oh, I wish this was my entry point. So starting point is just, this is a really good time to onboard people to Bitcoin because it's at a price point where you wish you could have bought maybe when you did at different times or whatnot. So that's one point. On the actual mining side, these are the cycles. Things that usually have the tendency to rhyme with the past and have a close rhyme usually end up changing because everybody starts to use that rhyme as the baseline. And so I would say that, historically, these bear markets, the time to kind of add mining capacity wasn't at the start of the bear market, right? There was usually some more pain to kind of go through and exhaustion. And so and I'll be wrong on this forecast, but
of course,
if I was going to start mining, I'd be, 8 months out. And I think that there's probably going to be a big drop in, the value of these ASICs in the next 8 months. And this is just looking back at the example again of, June 2020, when the revenue for Bitcoin mining for S9 was $30 and the energy was 30, right? That means that like they're at the money and people were selling those miners for $20. And they went all the way up to like near $500 during the height of the market, right? And so we're now at a point where that miner is making 40 right now, but power prices are, 80, right? They're much higher. So like that S9 miner is in a worse position than it was in 2020, but that mining rig price is still substantially higher. I'm not sure of the exact number, so call it like $100, right? Okay. So like, I think that miner should be worth less than it was in 2020.
Shaun right? Sees pain.
Yeah.
Shaun sees more pain.
Well, and it's just the logic of back again of the economics, right? Usually, human nature is to kind of survive as long as you can, right? And so some of these facilities will try and survive as long as they can, but there's a point that's a breaking point where if it doesn't work, it doesn't work. And again, just, what is a strong rhyme in the past isn't likely going to be the future. But if it did have a strong rhyme, I'd say that there's likely some more pain on some of those kind of miners, and that there's likely some great opportunities for people that want to get into mining to be able to pick up some of these low cost miners and to kind of set up their operation and be positioned for something afterwards. But a real big takeaway on this, and I think I shared on a prior podcast, is that I've heard some folks comment saying, as long as the hash rate of the network keeps going up, I know that the protocol is working, right? And things are good, right? And what I would share with others and want them to maybe think about that a little more is that, so we're at a lower price point for Bitcoin for we're coming at the same level for kind of the revenues for mining on the top line revenues. But what's changed substantially is the power prices, right? And as we're going into summer, I'm really excited to be on the other side of summer and to be able to have, a full summer of commercial operations with miners that are now at the money miners that are going to behave differently than they have in the past. And to be able to have this data that comes out of, the end of summer, especially like in ERCOT, and saying, how did these miners interact with the grid and how are they doing energy balancing? Because you get a lot of really smart people on energy Twitter that are calling that out, saying that there's no price responsiveness for mining because they're so deep in the money and they only curtail for a certain amount of hours. But we're going to go through summer here where, they're going to be lower break evens, the power price can be higher, and they're going to do the right thing, which is they're going to curtail their energy so they're not, trading in a $20 bill for a $10 bill. They're just going to hold that. And so I'm excited to kind of see the end of summer here. So there's data supporting how mining isn't just providing the capacity for ancillaries like they have in the past, but has this ability to be price responsive, which is going to be a really big benefit, I think, for summer power here, and be able to turn off earlier with these lower break even. So
do you worry about maybe like government subsidies to the cost of power, providing like inaccurate price signals and making the market just almost phony? Like, do you worry that we would have the U.S. government put subsidies on power where they're pretty much footing the bill?
So I'd say that the U.S. has regulated markets and deregulated markets. Deregulated markets can be broken out into competitive wholesale markets, right, and also competitive retail markets. And so what this means is that on the deregulated wholesale market is generators compete with one another to provide the lowest cost energy, right? And there's a fair kind of marketplace that's being run by these grid operators that allows these utilities or customers to procure energy at the auction cleared price, right? Mm-hmm. And so those are great markets because there's an auction price for the ancillary services, for the energy, very transparent, and really beneficial for miners to be able to kind of locate in these areas and provide similar services that generation provides in those areas. But you need to have that structure for participation. Mm-hmm. So that's deregulated wholesale. On the deregulated retail, that means that consumers have the choice of their energy supplier, meaning that, and I listened to your last podcast the other day, and you were talking about co-op, about not being able to, have a different rate, right? And so like that co-op could be, well, the co-op is more of a regulated entity, right? Mm-hmm. But that co-op might be able to participate in a deregulated wholesale market where the co-op can buy the energy based on this, this clearing price in this region, but then you don't have a choice on who you can buy your energy from. It's just the co-op, mm-hmm. right? And so every region is different. And there's 13 states in the United States that are deregulated retail, where you have the choice to be able to buy power from who you want to buy, and you're not just stuck with one. Okay. So just framing that as kind of like that's your deregulated, and then the regulated is your traditional monopolies, where they own the generation, the wires, and the customers. And so like in the US, there's 2/3 are in deregulated markets and 1/3 are in regulated. In the deregulated markets, you can't really kind of, subsidies don't show up in there because it's essentially, people putting bids and offers, and there's a clearing price, right? So like there's no way to kind of fudge the outcome. And then you think about these kind of monopolies as like they're trying to get some rate of return for their investors or for themselves. And so like they're not going to be they're going to be profit seeking as well, right? And they're mm-hmm. regulated by a utility commission. However, is that the US does have a subsidy on renewables, and there's a subsidy called the production tax credit, which is essentially given to wind generation, where they receive additional dollars per megawatt hour for every wind megawatt they generate, about $25. And then there's a investment tax credit with solars and batteries, I believe, are ones that apply for these, and it's 25 to 30% tax credit. That was the portion of their capex spend that they had on the project. So it makes these projects more economic to incentivize more of them to come. And so those mm-hmm. can distort the actual clearing prices in these markets because there is a subsidy that's being paid to these renewables, but it's not a direct subsidy by the local grid operator. And that's at the federal level that happens with renewables. It might happen in other countries at like subsidy mm-hmm. level that they're making. They have them in Mexico, I know for sure, and some other countries. But the US is the subsidy that is most impactful on power prices is these renewables for production and investment tax credit.
So you don't see a world where they subsidize all energy, like substantially, and just really screw the price signals?
Again, this goes back to like regions, right? Like, I kind of think about it like, the same way that how they do taxation in in Texas would be different from California, which would be different from Alberta, right? Like every region has their own methodologies for how they're doing taxation, and that's the same thing for power. For the most part, on how are the rules exactly set up on how they allocate transmission costs, distribution costs, et cetera. So there can be a federal subsidy, and I heard this recently, and I haven't researched it beyond a headline, but there was the federal tax on gasoline being reduced, right?
I heard the
and so
same
that's a federal subsidy, and that rhymes with UBI, right? That's like filling the hole by saying we're not going to tax you at the pump, right? And so I'd say that there's the likely ways that governments are going to try and make it less painful for the power for energy prices, but it depends on the tools they have available and how they can do it. It's a little more challenging in power markets to do that, but yeah. So I'm not 100% certain that there'd be subsidies going up for power, and miners are just going to gravitate to the lowest cost power. And what's great about the United States is there's a framework where there's deregulated markets that miners can actively participate in. The term you hear is demand response, but really it's participating in these kind of ancillary service markets and providing services that were once just supply side from generation, like coal and natural gas. So it's really helpful when they can enter these and build that into their economics. But they're just looking for the lowest cost energy wherever that is.
Do you like if you needed to or wanted to speak to somebody in like charge, like who is the ideal person to hear the message of like how Bitcoin mining and demand response and ancillary services, like I'm just throwing a bunch of jargon together, but can make renewables more like I guess usable, like you make it work? Who needs to hear that message?
Yeah, so I think that so I'll ask for a mulligan that could be kind of changing my answer a little bit. I'm a Canadian, right? So just as I'm sharing a response about what to do in the U.S., I want to have this big disclaimer that I'm a Canadian. I have no right to tell the Americans what to do on this. But I'd say that you want to have some policymakers hearing this. People that are making decisions about kind of whether this is a benefit to grids or not. I think first steps that are happening right now, which is fabulous, is that ERCOT's a very special place. It's a great place for businesses to go, and that ERCOT's been fabulous in kind of how do you accommodate these really large loads. It's really insane to think about the amount of loads looking to connect into their state, and figuring out a way on how to kind of create the right process for doing so that they can still have reliable power, right? And they've been absolutely fabulous and a leader in the space. The CEO, his name is Brad Jones, he had some comments about how, mining to the degree that they're flexible, is really a great tool for these grid operators in managing kind of, pretend there's like a solar ramp where have the average load in ERCOT's about 50 gigawatts, and pretend you have a solar ramp that's 10 gigawatts, right? So 20% of your load and growing every year is like, how do you do that handoff, right? Where you have all this solar coming offline, you don't have any access to imports from other regions. So you got to do it locally through batteries, through demand response, through natural gas plants. But there's this handoff. And as you retire more of those fossil fuels, they want to have tools in their kit, right, to be able to kind of manage this. So I'd say the start point is that, Brad Jones has been great for being a voice of saying, what is the grid operator that's seeing the significant increase of loads in mining, being kind of the spokesperson, which is remarkable, and kind of messaging that. And so you'd want to have that heard by other grid operators, such as, MISO, PGM. These other areas also have programs similar to what ERCOT has, that loads can participate in the same type of kind of programs. The reason why they're in Texas right now is that the economics are best there. And eventually I believe that there'll be more showing up in these other areas. But you want to have these kind of policymakers hearing what these grid operators are saying as they're starting to think about, big picture decisions on saying, is Bitcoin a good thing as it relates to energy? And is it helping with this transition or hurting it, right? And so that's kind of, the narrative that you really need to share. And again, back to what I was commenting about, of really looking forward to the end of summer, because you're going to have real data coming out of, how are these mining loads interfacing with the grid during a period of really hot weather, high power prices, and what were they doing, right? And so that's going to be really fabulous to kind of, come out of that and to be able to, to share that and I imagine probably hear quite a bit about that after summer.
So summer's the hardest time of the year for the grid to provide the correct response.
Yeah. And so think about like the higher the demand, the more resources you need. And if you don't have enough resources, you can go into blackout. Biggest use of kind of electricity at the residential level would be, air conditioners, appliances, right? So like air conditioners are at full in the summertime, which really drives up that load. So summertime has the largest peak. ERCOT has already set a system-wide record in June a few times. It's now at approximately 76.5 gigawatts. For perspective, is that Alberta, the province I live in, is 10 gigawatts for the entire province. New York ISO is about 30 gigawatts, right? So Texas at 76, that's a very big power pole. And as we go into summer, they're expecting that to be, up around 80 gigawatts. So like it's never seen before record loads. And so having some type of load that will turn offline when we reach those new kind of levels, that'll be great to see.
Okay. Well, Shaun, you have given so much time to this podcast. Like honestly, cannot tell you how grateful I am. So I don't want to take up too much more of your time. I know you're going on vacation, but when you're on Preston's show, you talked about some books that brought you down the rabbit hole that you didn't think you would ever read. What are your Bitcoin books? What really kind of changed your view and made you be like, oh my God,
yeah, this
is it?
So the one book that I read was called Inventing Bitcoin. And
is that Antonopoulos?
No, and his name is on the tip of my tongue here. I was just looking. Usually I have a stack of books.
I'm going to Google it right now to give credit to the author.
Jan Pritzker.
Oh, okay.
Yeah. So this one, Inventing Bitcoin. And
I need to read that.
What I love about it, and shout out to Jan on this, is that it really gives people kind of an understanding of the elegance of the solution for Bitcoin and kind of what is the technical solution. And so Jan did an excellent job kind of how he outlined, what is the problem, what problem needs to be solved, like why was Bitcoin created, and to really understand the why first, and then going through the details of how does mining work, like why do you need to spend energy to be able to participate in this virtual lottery for winning this block, why can't it be free? And so really an excellent overview. And for me is to understand why I share it with others is that I say if you read this book and you'll understand the difference between what is Bitcoin and these other protocols. And it's night and day. And so Jan did a fabulous job. And the best part too for sharing with others, it's the tagline. It's like a 100-page handbook, which doesn't make it sound intimidating to read because it's just a 100-page handbook. Yeah.
Any non-book like Bitcoin books that you really love?
I'm always a big fan of history and just understanding kind of how we got here. Some of the things like Sapiens, I mentioned as well that another book for power that's kind of like the Sapiens version was called The Grid, and understanding kind of the history of the grid and how we got here. Because I think a lot of the times is that we see a problem in front of us and we naturally try and figure out what the solutions are. And if we knew, usually we're exposed to 1 or 2 years of history, right, to kind of figure out, oh yeah, I remember that and this is the problem. But to really deeply understand kind of how the problem came to be is understanding a further timeline of history. And so for power grids, of understanding the last 120 years is extremely helpful in understanding why is power different in United States and in urban areas versus rural areas. Why is it different in Britain? So just really understanding kind of why are these systems different across the world, and because they all have the same problem right now, which is they're trying to do this energy transition, but they don't all have the same tools available or market designs. And so understanding kind of that history, how they came to be, kind of really helps you think about what that future could look like. So yeah, I'm really keen on understanding history to better understand where we're heading.
All right, so I wrote all 3 of those down. And then one last question for you, and then we can let you do a handoff and get your vacation started. But say a young adult was listening to this and they were very interested in your line of work, and maybe they wanted to model their life after kind of what you do. What path would they take? Say they're a high schooler. How would they plan their future in order to do, what you're doing eventually?
Sure. So I gotta think fast on this one. So I'd say that like it's easier to look back and to kind of connect the dots on kind of why it worked out the way it did, which I don't think was incredibly transparent at the time, but was more luck than anything, to tell you the truth. And so what worked along my journey was when I came into my career was in 2002, and so these power markets were just being deregulated, and I'd always been fascinated by trading and trying to understand financial markets, and so this was a real just gravitated towards it. And what was fortunate for me at the time was that since markets were just being deregulated, is that there was no books written on how to do it. And when I started, is that it'd only been around for 8 months or a year, and so nobody really had more experience than me, right? So like I got to into a career where I was there for about 15 years, and right from the start, there weren't a lot of people that knew more than I did about this space, right? And so it allowed me to grow and to kind of be able to take on more responsibilities quicker than it would have been if I would have gone into, say, a equity trading that's been established for a very long time, and you start at the bottom and it's really hard to work your way up, and you may never get there. So I'd say that it's entering a space that is really kind of undefined, right? Mm-hmm. And is new, and where there's not a lot of folks in front of you, but that still offers a great opportunity to learn along the way, so that it expands your thinking. So I'd encourage folks to look for spaces that there's not a lot of people with experience, and there's not a lot of people that can explain the space, and just go and kind of roll your sleeves up. And if it's a place that you enjoy doing, then you can't lose on that. So that's what I'd suggest.
Awesome. Thank you, Shaun. I kind of wanted to know for my own self, and then I framed it as if.
How about you? You get to finish on something like that.
Oh, how about me?
Yeah.
Like if someone wanted to do what I do?
Yeah.
So I was a
Don't sell yourself short.
I'm gonna.
Don't sell yourself short.
So growing up, I just wanted to be a firefighter. My pawpaw was, my uncle was, my cousin was, still are. And so I did that, and I did it for 6 years, and I kind of just got tired of the sadness, like, not to make this too depressing, got tired of all the most painful parts of people's life being my day job. So then I just kind of sold out for more money and go work in a refinery. But that's not what I want to do. Like, this is what I want to do. I just want to talk to interesting people. I want to learn from them, and then hopefully one day I can do this well enough to make a living off of it. And that's it.
Cool. So what I heard you say was when you're on a treadmill in life and you're doing something that you kind of enjoy, but it's not something that you're just enthralled with, is take the risk and hop off the treadmill and make the switch to something that you're really passionate about. So that's cool.
Yeah. And dude, this terrifies me. Like, I have miniature panic attacks before every interview. I was like,
yeah.
But Shaun, if you want to give him a handoff, man, I really appreciate you. The smartest man I've ever talked to in my life, by the way.
Cool, man. Well, thank you. And I like I was saying before the podcast, is I've experienced in certain areas in a certain niche, right? And so just happy to be able to share this with others. So for folks that want to kind of follow myself, is that I'm on Twitter at Shaun Energy, so SHAUN Energy. My DMs are open. Feel free to reach out. Happy to have a conversation, and check out some of the stuff. I post a lot of content on there, and hope you enjoy it.
Thank you, Shaun. You really do have some very interesting threads, so I recommend anybody who listens to this to follow you and check it out. All right, cool. That's the interview.